journey in your last two. I swim with tea when they turned in. The siren now to mute. And can lend a pole that some kid died.
One of the biggest misconceptions about shareholder loans is that receiving a loan from your corporation automatically creates taxable income. In most cases, that is not true. Simply borrowing money from the corporation does not immediately result in tax. At the time the loan is received, it is generally treated as a genuine loan rather than income. However, the tax treatment changes if the loan is not repaid within the time allowed under the Income Tax Act. So the real question is not, did the shareholder receive a loan? The real questions are, was the loan repaid? And was it repaid on time? If the shareholder repays the loan within the required repayment period, the loan will generally not be included in the shareholder's taxable income. But if the loan remains outstanding beyond the permitted deadline, the CRA may include the unpaid amount in the shareholder's income, resulting in additional personal tax. This is why timing is so important. A shareholder loan is intended to be temporary. The tax rules encourage shareholders to repay borrowed amounts rather than leaving them outstanding indefinitely. As tax preparers, we therefore focus not only on the loan balance itself, but also on the repayment timeline. Monitoring both helps determine whether the loan remains tax-free or becomes taxable. The key takeaway is simple. Receiving a shareholder loan is usually not the problem. Failing to repay it within the required time is what may trigger a tax liability. The shareholder loan repayment rules are all about timing. Receiving a shareholder loan is generally not taxable when the money is borrowed. However, the Income Tax Act expects that loan to be repaid within a specific period. If it isn't, the loan may no longer be treated as a genuine loan and can become taxable income. The repayment period is measured using the corporation's taxation year. The clock does not start on the day the loan is received. Instead, it begins at the end of the corporation's taxation year in which the loan was made. From that year end, the shareholder generally has one full taxation year to repay the outstanding balance. This is why understanding the corporation's fiscal year end is so important. The repayment deadline is based on the corporation's taxation year, not the shareholder's personal calendar year. If the loan is fully repaid before the deadline, there is generally no income inclusion, and the shareholder avoids additional tax on the borrowed amount. However, if the repayment deadline passes and the loan is still outstanding, the CRA may include the unpaid balance in the shareholder's taxable income. This can lead to additional personal tax and, if discovered during a review, a CRA reassessment. For tax preparers, this timeline is one of the most important planning tools. Monitoring shareholder loan balances throughout the year and knowing exactly when the repayment deadline occurs allows potential tax problems to be identified well before they arise. The key takeaway is simple. A shareholder loan does not become taxable simply because it exists. What matters is whether it is repaid before the repayment deadline. When the timing is managed properly, the shareholder can often avoid an unnecessary tax liability. The best way to avoid tax on shareholder loans is not through complicated tax planning, it is through good year-end management and proactive monitoring. An experienced tax preparer does not wait until the tax return is being filed. Instead, they review the shareholder loan account well before the repayment deadline. The first step is to determine the current shareholder loan balance. Once the balance is known, the next step is to identify the repayment deadline based on the corporation's taxation year. If an outstanding loan exists, the tax preparer can work with the client to develop a repayment plan. This may involve repaying the loan in cash, offsetting it against other legitimate amounts, or using another appropriate method permitted under the tax rules. Just as important as making the repayment is recording it correctly in the accounting records. A repayment that is not properly documented or recorded may not achieve the intended tax result. Good documentation is also essential. Loan repayments, supporting schedules, bank records, and accounting entries should all be maintained so that the corporation can demonstrate exactly what happened if the CRA ever reviews the file. The key is to review everything before the repayment deadline arrives. If the loan is repaid on time, the shareholder can generally avoid having the outstanding balance included in their taxable income. However, if the deadline passes and no repayment has been made, the loan may become taxable, resulting in additional personal income tax. This is why tax preparers place so much emphasis on proactive planning rather than last-minute corrections. The key takeaway is simple. Monitor the shareholder loan account regularly. Know the repayment deadline. Plan repayments well in advance. And ensure every repayment is properly documented. A little planning today can prevent unnecessary taxes and costly CRA reassessments tomorrow.